Hey there and welcome to the channel. In today's video, we are doing part 2 of the how to invest in the stock market for beginners. If you haven't watched part 1, go to the description and make sure to check that out before watching part 2. But before we start diving in, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. Next up, I want to talk about avoiding scammers, which is really important, especially when it comes to investing and the finance space. There are a lot of scammers on YouTube and other platforms, so it is really important for you to do your own research on every stock that you are going to buy. It's not enough that you listen to some random guy on YouTube talk about how great this company is. You have to take a deep dive into their financial, their business model, and have to look for any red flags that could indicate that it would be a bad investment for you. And if somebody is promising you high returns, especially if they are guaranteed and they are promising quick profits, it usually is a scam. And I would say if you always turn down these offers, you would probably be ahead over a lifetime of investing. And I do think a lot of people that are investing in the markets, they don't understand the investments they are going into. And sometimes when other people are making a lot of money really fast, we have to be able to let go of our ego and just say, I don't understand this, and be able to walk away. Next up, we're going to talk about the psychology of money. And when it comes to investing in the stock market, understanding the psychology of money is just as important, if not more important, than understanding the numbers. And we do have a lot of biases which are hardwired into our brains through evolution. And that leads us to make irrational decisions which are based on emotion rather than logic. And a great quote that I have from Charlie Munger in his book Poor Charlie's Almanac is about the human mind, which is a lot like the human egg. And the human egg has a shut-off device. When one sperm gets in, it shuts down so the next one can't get in. And like the human egg, our minds have a shut-off device that prevents us from considering all available options and making rational decisions. Now, these biases here are some of the most common biases which affect our decision making in the stock market. The first one is the confirmation bias, where we are seeking out information that confirm our existing beliefs and they ignore the information that goes against them. And I've had that happen to me personally, where I'm just doing a Google search to try to confirm what I already think, and I'm not looking for any evidence that contradict my theory. Then you have loss aversion, where we feel the pain of losses more acutely than the pleasures of gains, which leads us to make overly conservative decisions. Now, you've probably seen the research where people act much worse to losing $100 than gaining $100. That's loss aversion at play. Then we have overconfidence, which is really common with especially new investors, where we tend to overestimate our abilities and the accuracy of our predictions, which leads us to take too much risk. And I've done that personally as well. Then finally, we have the bandwagon effect, which is where people adopt certain behaviors, styles, or attitudes simply because other people are doing it. It is the herd mentality. And the bandwagon effect is really common in a strong bull market, where you see retail investors hop on the bandwagon very late, where they go up and they end up crashing down with the stock and losing a lot of money. Next up, I want to talk a little bit about investing in ETFs, but this video is mostly focused on picking individual stocks. But I think investing passively in ETFs or index funds is an excellent investment option for most people. And Warren Buffett himself even says that 99% of people should be investing in ETFs. And ETFs are great in the sense where they offer you lower fees and greater flexibility to buy and sell, and they are also really tax efficient. I would personally recommend Vanguard. I have investments in Vanguard myself, but the important thing is to look at what you are really buying and what the expense ratio is. Now, there are tens of thousands of ETFs and index funds to choose from, but the most popular ETFs are the SPDR S&P 500 or SPY, and the SPY is similar to the Vanguard 500 index, VOO, but they both invest in the 500 largest companies on the US market. Then you have the Invesco QQQ Trust, which invests in the NASDAQ index. Then you have the Vanguard Total Stock Market ETF, VTI, which invests in all of the listed companies in the US. Now you can go to a site like tdameritrade.com and compare all of these ETFs. And we can see here that the 1-year return has been the highest for the QQQ, but he is also the most expensive with VTI and VOO having the lowest expense ratio. You can also compare the sector breakdown for the ETFs and their top 10 holdings. Now, this is something that I won't be digging further into in this video. You have plenty of videos on YouTube where you can go deep into the ETFs and study them if that is your investment strategy. Now, accounting is really important if you want to learn to be an investor, and Warren Buffett has often referred to accounting as the language of business. And Warren has emphasized the importance of understanding the financial statements and how accounting principles work. And he has advised investors to focus on companies that have both transparent and understandable financials, because obviously that is very crucial to be able to evaluate the performance of the business and the future potential. Now, the financial statements that you have to be able to read are the income statement, the balance sheet, and the cash flow statement. And the income statement is showing you the financial performance of the company or what the company is earning through a period of time. The balance sheet is a snapshot of the financial health of the company and tells you what the company owes and owns. That is to say, what kind of assets the company has and their liabilities. Then, last but not least, you have the cash flow statement, which shows you how the company is managing their cash, where you can see their cash inflows and outflows. And just to show an example of how we would check out the income statement, balance sheet, and cash flow statement for a company, we can go to a website called quickfs.net. I will leave the link down in the description. There we can take a look at a company called Meta Platforms, which is the biggest company in my portfolio. And if we go here, we can check out the income statement for Meta for the last 10 years. And what I would advise you to do, which is something that I did personally, is I just went through the income statement line by line, and if I didn't understand the concept, I just Googled the concept or watched the YouTube video. And then slowly and surely you will be able to learn how to read the income statement and extract the highlights. And through practice, it will take you less and less time to be able to spot out the really good companies. Now, if we run quickly through Meta, we would see here that the revenue went from 7 billion in 2013 up to 126 billion for the last 12 months. And the reason we have the last 12 months here is because they haven't given us the numbers for the year, because the year hasn't finished yet. And then you can see the next line is cost of goods sold, which is how much did it cost the company to make the product. And we can see the cost was 26 billion, which gives Meta a gross profit of 100 billion. Then you have all kinds of operating expenses like sales, general and administrative. And you have the company also trying to grow, where they put money into research and development. And the total operating expenses for Meta for the last 12 months was 63 billion, which gives us an operating profit of 36 billion. We then go through these lines here to find out that the net income, or the bottom line for Meta for the last 12 months, was 29 billion. And if we compare that to, for example, 2021, we can see that the net income was actually 10 billion higher in 2021 than it was for the last 12 months, which is obviously something that we don't want to see. And here you can see the progression of the EPS, or the earnings per share for the company, that went from 60 cents up to $11. And EPS, or earnings per share, is the net income of the company of 29 billion divided by the shares outstanding, which gives us an EPS of $11.33. Now, this is of course just to introduce to you how you would look into a company's financials, but I have other videos on my YouTube channel where you can see me dive deeper into the financials for companies like Meta and many others. Next up, we would check out the balance sheet for Meta. Now, the riskiest thing you could do in investing is to invest in a company that has a bad balance sheet. Because if a company has a bad balance sheet, has, for example, a debt that they are unlikely to be able to pay back, it is likely that you will lose all of your money if the company goes bankrupt. Now, if you look at the assets for Meta, they have a lot of cash on hand and short-term investments, which is something that's always good to have. And if you look down here, we can see the total assets for Meta are valued at $185 billion. Now, Meta has current assets of 59 billion, which are assets that the company can easily turn into cash in the next 12 months. And we compare that 59 billion to the total current liabilities of 27 billion. But current liabilities are liabilities that the company has to pay in the next 12 months. Meta doesn't have any short-term debt, but they do have a long-term debt of 9.9 billion, which is not a lot if you consider the fact that they have $14 billion in cash and 26 billion in short-term investments. Now, Meta has shareholders' equity or book value of $125 billion, which is a number you can get if you take their total assets and deduct all of their liabilities. So I would say Meta has a pretty healthy balance sheet, which is good if you are a shareholder. Next up, we will check out the cash flow statement, which is really important as well. In the cash flow statement, you can see the net income, and we can adjust that for all of the non-cash charges of the company, which gives us the cash from operations for Meta. And the cash from operations is 66 billion for the last 12 months. And if we deduct this number, property, plant, and equipment, which is 28 billion, we get about 38 billion, which is the free cash flow for Meta, which is, in my opinion, and most of the value investors' opinion, the most important metric that you can track for a company. Now, Warren Buffett has described free cash flow or owner's earnings, which is a term that he uses, which is really similar to free cash flow. Imagine if you have a rental apartment, and once you've paid off everything, the mortgage, the taxes, and all of the maintenance on the rental apartment and everything that needs to be paid, the free cash flow is really the money that you get into your pocket. Now, he calls it owner's earnings, which is really similar to free cash flow. But free cash flow is basically the cash that the owners of the company have at the end of the year. And if you are investing in a company, you are a part owner, which means a part of the free cash flow is yours. So that's why it's really important to track how much free cash flow the company is generating. So just to give you an idea of my personal investment strategy, which consists mainly of four parts, where the first part is understanding how the company makes money and the key performance indicators that determine how the business performs. Number two, we're trying to analyze the moat of the company, which is the competitive advantage that the company has over their competitors. And Warren Buffett has used the analogy of a company being like this castle, where it's being protected by the moat around it, and the competition is trying to get in. Now, the competitive advantage that the company has against their competitors is really determined by how wide and how deep the moat is. And we are evaluating competitive advantages based on the operating numbers, and also based on a lot of qualitative factors, which is something that can't be necessarily seen in the numbers. Now, a very crucial part of my investment strategy is evaluating the management team, which includes checking if they are invested alongside investors, if they have so-called skin in the game, where we check if a meaningful portion of their net worth is invested in the company. Then it's obviously going to be really important for them that the company does well. And we are checking how they allocate capital, and also if they are high value people that have a lot of integrity. Now, finally, we have to calculate the intrinsic value of the company and determine a margin of safety for purchasing the stock. Now, first of all, how would we go about understanding how the company makes money and checking out these key performance indicators or KPIs? Now, if we continue with Meta, we would just go to Google and type in Meta Investor Relations, where we would find their financials. And you can do this with all publicly listed companies. You can look up their financials by just typing in the company name and putting in investor relations. And here we can see the latest numbers for Meta for their third quarter of 2023. But you can also read the earnings release for the second quarter, the first quarter, and the annual report for 2022. And you could even go back in time and read a couple of annual reports to try to get a hang of how the company has been performing for the last couple of years. And if we scroll down the latest earnings report for Meta, we can already see that they mention their key performance indicators here, which for Meta are numbers of daily active people, DAP, monthly active people, MAP, and average revenue per person, ARPP. And these metrics are based on the activity of users who are using their platforms, Facebook, Instagram, Messenger, and WhatsApp. And if we go to the revenue section, we can see that Meta makes most of their money, almost all of it, through advertising, where in the quarter they made 33.6 billion in advertising and only 293 million through other revenue. And if we look further into the key performance indicator for Meta, we can see that family daily active people actually saw an increase of 7% year over year, and it was the same increase for family monthly active people. And Facebook also saw a growth of 5%, which is positive for the company. And the ad impressions, which are very important for an advertising company like Meta, increased by 31% year over year, but the average price per ad in the third quarter decreased by 6%. That definitely gives us some idea of how the company makes money and their key performance indicators. But we would definitely have to read all of the reports and the reports for the last couple of years, and probably have to read the write-ups about the company to be able to fully understand in depth how the company works. Now, when we are analyzing the mode of the company, we would really have to dig into the operating numbers and compare them to their competitors. But in my opinion, Meta has a duopoly with Google, where they are the two leading firms in the world when it comes to online advertising. Now, of course, Meta competes with other companies in the social media space, companies like Snapchat, Twitter, and TikTok. Obviously, YouTube is owned by Google. But if you would take a look at the financials for Snapchat and Twitter when it was public, you would see that they aren't really competing when it comes to the numbers. TikTok, on the other hand, is a private company, so we don't have access to their numbers. But I do know they are losing a lot of money. Now, for a quick overview of the numbers for Meta, you could go to a website like gurufocus.com, where you can see the highlights for the numbers that really matter. And here you have the growth rates per share for Meta when it comes to revenue, which has been really strong for the last 10 years. EPS, or earnings per share, has also been strong, but slowing down for the last year. And then you have free cash flow, which I mentioned is the most important measure for the company and how the intrinsic value of the company is growing. And Meta has seen a pretty strong growth in their free cash flow numbers. And finally, you have the growth in book value, which is also pretty strong for Meta. Now, if you were evaluating the management team of a company like Meta, you would, for example, check out the CEO, which we know already is Mark Zuckerberg. And Mark Zuckerberg has almost all of his net worth invested in the company, which is valued at over $100 billion. But we also want to see how they are allocating capital, and for that we have to go back to Guru Focus. And here we can see the three most important metrics when it comes to allocating capital. They are return on invested capital, return on capital employed, and return on equity. And with the companies that I'm personally invested in, I want to have these numbers all above 20. And for Meta, they have return on invested capital of 21%, the return on capital employed of 22%, and return on equity of 22% as well, which is really good to see. And finally, we are calculating the intrinsic value of the company and determining a margin of safety for us to purchase the stock. I will show you one of the many methods to calculate the intrinsic value of the company, a method that's called DCF, or discounted cash flow analysis. But before we do that, I do want to explain to you what margin of safety means. But the margin of safety is a fundamental principle in investing. It is really the difference between the intrinsic value of the stock and the market price. And you can read all about the margin of safety in chapter 20 of The Intelligent Investor and also in Seth's book, which is called Margin of Safety. So when we are investing and using a margin of safety, we are really protecting ourselves from potential losses and trying to increase our chances of achieving long-term success. And the best analogy comes again from Warren Buffett, but he really has a lot of good analogies, where he gives an example of if you were building a bridge, which you will only be driving 10,000-pound trucks across it, but you still insist on the bridge being able to carry 30,000 pounds, then those 20,000 pounds in between, they are really your margin of safety. And here we can see an image that really explains the concept, where you have the intrinsic value of the company slowly growing and the market price goes down. The gap in between the intrinsic value of the company and the stock price is what we call the margin of safety. Now, the margin of safety also protects us in being wrong when we are evaluating the intrinsic value of the company. Maybe the intrinsic value of the company is not here, but a much lower number somewhere here. But if we are investing with a margin of safety, we still have plenty of room between the intrinsic value of the company and the actual stock price. Now, this is just one of the methods we can use to try to find out if a stock is fairly valued or not. And this method is called DCF, or discounted cash flow analysis, where we have the stock price of $332 and we always want to use the free cash flow of the company, which, like I mentioned, is the best measurement of the true value of the company. Now, we use a discount rate of 10%. And if you believe the company can grow for the next 10 years by 20% per year, and then by 4% the next 10 years after that, the fair value for the stock price would be $492, which would give us a margin of safety of 32%. Now, personally, I don't believe that Meta, which is already a huge company with a market value of 820 or 30 billion, can grow for 20% for the next 10 years. So the fair value of the stock is, in my opinion, much lower than the $492. But I'm just giving you an example to show you how the margin of safety works. Now, this is something that I wondered when I was starting my investment journey, was how much should I invest? But while investing is important, it is also really important to start small and learn as you go, because you can't be afraid to make mistakes and learn from them, because you are going to make mistakes. I can promise you that. And you will definitely lose money. But the most important thing is to get started right away and learn by doing. Now, you can go to a site like investopedia.com and start to paper trade there. They will give you a virtual portfolio of $100,000, which you can buy some stocks and watch how they are progressing. But it is similar, in my opinion, like if you wanted to be good at playing golf, you would actually have to go out to the golf course and play golf. It is exactly the same thing with the stock market. You actually have to go out there and start buying stocks. You will learn much more by actually doing that than reading any books or studying the subject. But don't get me wrong, you also have to continue to study and get better every day as you try to master the craft. Now, in conclusion, investing in the stock market, like I've been talking about for the whole video, is a great way to grow your wealth over time. But like we talked about also, it is really important to do your own research and understand the risks that are involved. Don't be dependent on somebody else giving you advice on where you should invest your money. And you have to remember to avoid making emotional decisions which are based on short-term market fluctuations. Like Graham has taught us, you can't be a servant to the market, you have to be a master to the market. And you have to remember, you are buying an actual business. You're not just trading papers back and forth. And you are investing in a business for the long term. So patience is key. And you have to continue to learn and evolve. You have to become a learning machine, like Charlie Munger talks about. And finally, what are you waiting for? Go out there, start your brokerage account, and get started. But that's it for the video today. Remember to like and subscribe if you got any value out of the video. I want to thank you for watching, and I will catch you on the next one.